Hi students, today we're going to continue with a look at long-term liabilities, and specifically we're going to go over an example of a capital lease. Now if you read the module commentary, you'll note that a capital lease is a name for a lease under ASPE, and a finance lease is a name for a lease under IFRS. They're very similar, and there are just a few account title differences, but not very many differences. So I'm assuming that you read that module commentary, and we're going to just jump right into the video here. So here's our example. We have a lease of equipment. It's going to be a 5-year lease, and the rate is 9%. And here's just the date of our lease, September 30, year 1. Now, typically with leases, the payments are due at the beginning of each year. If you did get a financial calculator and you want to calculate the present value of a lease, you need to set your calculator to what's called begin, with usually a second function and a begin key. And that means the first payment is day 1. Now, interest is a charge for money over time. So the first payment has no time. It's just like you signed the lease and you gave them, in this case, $14,000 right up front. There's no interest attached to that first $14,000 because no time has gone by. Now, in this course, you do not have to calculate the value of the lease on your own. I'm just going to give you this value. So I calculated this on my financial calculator, and here's our 59,356.08, which is the present value of all of the lease payments you're going to make, brought back to today at 9%. So that's our interest rate on the lease. And as we owe money on the lease, every year we're going to be charged interest at 9%. So part of this $14,000 covers interest expense, and the rest of it pays off our lease liability. In this example, there's no residual value to the item, and it will be returned to the owner at the end of the lease. So the first thing we need to do is build a lease amortization schedule. And this is very similar to your bond amortization schedule, and very similar to a table you would create for a long-term note payable. So if you get this right with bonds, you can use that knowledge and again with leases and notes and even mortgages. So let's move over to the amortization table over here. So what we have is our beginning lease present value, and that was, just a moment ago on the screen. This is September 30, year 1. Now note, the first payment is also September 30, year 1, so the full $14,000 reduces the liability of that lease. So we just take the $14,000 off, and we're only going to be charged interest on $45,000. So here are your 4 more payments. 1 payment a year every September 30. So just like you're very similar actually to your bond amortization schedule, we're going to take the lease amount, which is the liability under the lease, we're going to multiply it by the lease rate, and that lease rate, just to remind you, was 9%, and that gives us interest of $4,000. So of that $14,000 payment, $4,000 and change is an interest expense, and $99.18 pays down our lease liability. That's a principal payment on the lease. So now we only owe $35,000. And as you can see, if you roll this schedule down, again, like for example, really quickly, the next year, $35,000 times 9% interest is $31.89. You still pay $14,000. Interest expense is $31.89, and $10.8 goes to the lease liability. And you can see after the final payment, you paid off your lease. So basically you used this equipment for 5 years and you made 5 payments of $14,000, and that included principal and interest. So let's look at a couple of journal entries for this lease. So the first thing we do is we say this is a capital lease, or if it were IFRS, it would be a finance lease. And what did we get? Well, remember that a capital lease is basically saying this is the same as if we had bought it. So we're going to have to put this on our balance sheet as a long-term asset. We're going to have to charge depreciation expense just like we would if we had purchased it. So our first journal entry then starts with equipment, because we leased equipment. Now, someone might write equipment under capital lease. I don't bother with that. I think just writing equipment is fine. But notice it's for the beginning present value of the lease. The first thing we do, also September 30, is we pay cash of $14,000, and that gives us a lease liability right here, that number, $45,356. Okay, so we've recorded our lease, and along comes the end of the year. Well, as the end of the year comes along, we have to accrue interest from September 30 to December 31. This should sound a lot like a note payable or a lot like a bond payable. We have used their equipment. We're being charged 9%, and we have from September 30 to December 31 to accrue interest. So I've done the calculation, or the start of the calculation over here. Recall that our lease liability started at $45,000 and a bit. The rate is 9%, and end of September to end of December is 3 months. So 3 months out of 12. So what I'm going to do is I'm going to take our lease amount times the interest rate times 3 months divided by 12 months. And I'm going to turn up this column a little bit. There. So that's 1,020 and 51, and that is September 30 to December 31. Now what I'd like to do is I'd like to point your attention to this amortization table. The full amount of interest for a year is going to be $4,082, but we're carving out 1/4 of that. And if you do this in your head, we're pretty much to the penny, aren't we? 3 months out of 12, or 1/4 of 4082 is our 1020, and Excel calculated 51, so a penny. So basically that is our interest expense in December. So what I'm going to do, notice this is color coded, I'm going to take this, and here is our interest expense. I've rounded to the dollar. Now our interest payable is the same amount. So we have an interest expense and we have an interest payable. Now, we also have to depreciate this equipment. So let's look at how we depreciate this equipment. The present value or beginning amount for the lease was $59,356. We're keeping this equipment for 5 years, and in this question there was no residual value, which means we don't have to take away anything. So we're just going to go 59,356 divided by 5 years. And there's our amount. Okay, so that's straight line depreciation, everybody's best friend when it comes to depreciation. I'm sure you remember straight line. So that number goes here. So here's our journal entry on December 31 for depreciation expense and accumulated depreciation. So along comes September 30 year 2, and we have to make our payment. So let's sort of look at what we have to do to make this happen. First, I'm going to put these account titles out. We're going to have interest expense, and this is from the end of the year to September 30, so the other 3 quarters of your year's interest. Our interest payable is the amount we decided was a payable before, so we're going to pay off this payable. That's the first thing. Now, our cash, I know I'm building this entry a little bit sideways. It's still going to be debits first when we finish, but I'm going to show you the sort of easy parts first. So we know that our payment for the lease is $14,000. So I've got my interest payable and I've got my cash. So what about the other 2 numbers? What's missing? Well, first of all, we know that the interest expense for December 31 to September 30 is the rest of 4082, which was a year of interest, less the 10.20 and 50 cents that we already accrued. So what I'm going to do is I'm going to take the amount, which is the interest expense for the year, and I'm going to subtract the amount that we already accrued, and let's do that. So the new interest expense is $30.62. Now, how much did our lease liability go down? Well, there are 2 ways to find this, and one is a check. So we know that journal entries have to balance. Now, because our journal entry has to balance, we need to know how much did our lease liability go down. And just recall that of this $14,000 payment, $4,000 and a bit was interest, and the remaining was a reduction of your lease liability. So your lease liability, notice on this table, is going down to 0. So I've got to debit my lease liability to reduce a liability. So what I want to do is put in my 99.18, which is the reduction of your lease liability. Now, did this journal entry add up? It may or may not, because we have rounded off a few numbers, but let's just do a sum in Excel and find out. Okay, it's 14,000. Good for us. So our debits equal our credits, always a good thing in accounting. Now, that's where we're going to stop this video, and the reason is the very next year you're going to be doing everything the same. These account titles are the same. The only exception is, well, you don't have to record the lease equipment again. But notice that September 30 year 2, what we did is we made our cash payment on September 30 year 2. We're going to do our cash payment September 30 year 3 and year 4 and year 5. So our interest expense will change every year using the same calculation. Our depreciation expense is straight line, so that's not going to change. That's the same every year for 5 years. And these account titles aren't going to change either. So September 30 year 3, 4, and 5, we're still paying $14,000. We're still recording our interest expense from the table and our interest payable. And notice that those were the 2 numbers that added up to the yearly interest expense. So, lease accounting at this level is fairly simple. That's really all we need to do with lease accounting. If you go on to intermediate financial accounting, in the second intermediate financial accounting course, you're going to do a lot more with leases, and we're going to be doing leases using IFRS as well. See you next time.